Welcome back to the second hour of the Big Money Show. I'm Dagan McDowell, along with my heroic co-host.
Ooh.
And with us for this hour, independent advisor, Jonathan Hoenig.
Hello.
Hello,
Happy
stocks.
holidays. Glad we're celebrating a bull market.
Hey, you don't have the floor. Let's roll on.
Take it over.
Hoenig. Stocks higher today after opening the final month of this year firmly in the red. We got a little bit of green, all three major market gauges to the plus side. But look at what these markets have put up in terms of green so far in 2025, set to finish this year with some massive gains. The NASDAQ up 21%. There's Taylor. Hi. And Wall Street.
I was sifting through my research notes.
I'm looking out for you.
Jonathan, Taylor.
I don't care. Wall Street analysts see a similar story for next year, 2026. Major banks raising their S&P 500 price targets. Some predicting a 14% surge next year. Those analysts saying strong earnings growth, more potential Fed rate cuts, deregulation, artificial intelligence, all big tailwinds. President Trump says Americans should be optimistic.
So the stock market has set 46 all-time highs, and this last Friday, which is called Black Friday, was the biggest ever online sales that there's ever been by a lot. More Americans are working today than at any time in the history of our country. I mean, these are the facts we have to get out.
Hoenig, portfolio allocation, 100% equities. Yay or nay?
I think that's nay. I mean, I follow that old rule of 100. They used to say you take your age, you subtract it from 100. That's the percentage you should be allocated to risky assets. So let's say a 50-year-old person should be about half in stocks, half in bonds. But I tend to be pretty conservative. And I have to tell you, Dagan, we are in pretty rare air when it comes to valuation here. I'm not a Cassandra, but even with some recent troubles, the NASDAQ's still trading at about 30 times earnings. So, you know, I like to follow Buffett's rule. I'm cautious when others are greedy. I'm greedy when others are cautious. And I'm a little concerned that people are a little too greedy given the market's recent run.
No, I'm just doing my stock allocation, so I should be 25% in stocks based on that equation. I don't
The
think
rule of 100. Look, this was a general rule of asset allocation for many, many years. And to your point from the earlier segment, today's generation of young people, they don't remember 2008. They certainly don't remember 2000.
I'm joking. I'm not 75. I still think, even if I did do my real age, that even like, you know, between 50 and 40, 40 and 50% in stocks is too little.
The 60-40 portfolio is dead, Hoenig, right? We've tried that. It doesn't work. It works maybe half the time.
And if you had a chunk in long-term treasuries,
how's your
in the
TLT doing? Pull the 5-year, the TLT for Dagan.
Oh, just nausea. 40% loss.
I guess just the point is balance. I mean, you talk to people now and they consider, if they own, the Big Seven, the Mag 7, they consider that a balanced portfolio. And all I'm saying is, if this bull market's going to continue, it is going to need to broaden. I've been heartened to see pharmaceutical stocks doing well. I mean, obviously gold is doing well. So we are seeing some of that because the Mag 7 is already priced for perfection.
But how do you know what balance is just let's say AI really is changing things as fast as they say, then how do you know what balance is? Like, it's reinventing the world in its image. Balance would mean a bigger chunk of AI-exposed stocks, wouldn't it?
I mean, it just seems like it's the same thing they said about the radio in the 1920s. The radio is going to change everything. The internet is going to change everything.
The radio did change a lot.
And a lot of those radio companies, what happened to them? They went out of business, and it was the same thing with the internet. Again, I'm not a Cassandra. I don't think you should be necessarily shorting stocks right here. Trends tend to persist. All I'm saying is that Cisco Systems and Intel, both integral stocks to the 1990s bull market, trade below where they did in January of 2000. So we could see a lot of these AI plays work out and at the same time see their valuations contract.
Okay, I agree with that. That is what I think is going to happen. And I also think that everything isn't going to just keep going up, 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 up. We had a couple of events here in the last 4 weeks or so where we've seen some selling off where it seemed like investors, like post-NVIDIA earnings, and investors were kind of hitting the brakes a little bit. I think that this is a market, Jonathan, that has just gotten way, way ahead of itself in terms of the excitement. And my fear is when that bubble pops or the music stops in the musical chairs, that people are going to be in for a rude awakening. And I don't know what's going to trigger it, but we've seen it before in cycles. Sometimes it could be something that's very, very fickle, very between the lines interpretation of an earnings report or guidance, where all of a sudden people lose confidence. And the problem is now you've got, we talked about it in previous blocks, all of this retail money in the stock market. Being able to time it perfectly is almost impossible. So I'm not looking forward to that. And I think it's going to happen sometime next year. I disagree with the banks and their targets.
Well, there's an old...
Or they may reach the targets and then you can see something happen.
The old saying, bull markets are built on fear. Bear markets are built on hope. So we don't see too much fear now. Taylor, to your point, especially with young people. Look, I remember in the aftermath of 2008, you couldn't get young people to invest in stocks. They wanted nothing to do with stocks. But it's taken years and years and years. And the one thing, to your point, Jackie, I think it actually could be bonds. A lot of people are betting on lower interest rates. You're actually starting to see interest rates creep up. That could be the canary in the coal mine for 2026.
Can we talk about bonds? Dagan, this is actually pretty serious, and I did this for you. Often the saying goes, and Jonathan, you'll correct me if I'm wrong, the smart money's in bonds, right? You'll watch the credit traders, and that will lead what the equity market does because they're more in tune with what is really going on in terms of cracks. So I read you this. Corporate bonds are no longer scarce, and tech spending evokes late cycle behavior. So effectively, the upside is narrowed, but one report says the credit cycle isn't over yet. We talk about the credit market like the economy, K-shaped, right? We aren't seeing cracks in the lower half just yet. There isn't aggressive CapEx or bond issuance plans yet, and there is some deleveraging. So until that changes, the cycle can run longer and returns in credit markets can stay positive. High yield they go on is in the opportunity. So again, you're seeing Mag 7, the ultra high fast, they're taking on credit, they're taking on risk. But frankly, and I pose this as a question, aren't they the ones who can? If you're pulling in $90 billion of free cash flow, if you're Apple, you can. If you're the low end guy, like the lower shaped of the K-shaped economy, and you're issuing all this debt, yeah, I'm a little bit more worried. But if it's Mag 7 doing it, am I not, I guess, more comforted because Microsoft's bonds are AAA rated, I think, higher than the U.S. government? So cool, I'll buy bonds from them all day long. I don't know.
And what she's indirectly saying is doesn't an investment grade mutual fund run by a really terrific manager look like a great investment here?
Well, I mean, Microsoft is a great example. Microsoft's a wonderful company, but it was dead money from 2000 to maybe 2013, 2014. Oracle, same story. Great company. They paid all their bonds on time. When I'm looking at yields, Taylor, I'm actually looking at government yields, at treasury yields. And I'm looking at a government that doesn't seem to be stopping the spending, in fact, encouraging spending more. And I'm seeing the potential, in fact, for inflation to, which we've all talked about being under control, just potentially rise once again. So that's my fear, not necessarily the actions of this corporation versus that corporation, but if we don't rein in spending, I think we're going to see a surge of inflation.
But we're talking about investing. But go ahead.
Can I throw something in there on this one? Because I'm perpetually concerned about inflation and government spending. But who was it? It was Elon Musk this week who said, man, these AI investments are so productivity enhancing and so growth oriented, they will swamp growth in the national debt. You're worrying about the wrong thing. We're going to swamp the national debt. Now, I'm not saying I totally believe him, but I do think this is a disinflationary, deflationary set of investments. more so than the radio, okay? So if you're betting on government to fall apart, you might be on the wrong side of this one.
From your mouth to God's
No,
ear.
I know that's hopeful, but like I do think AI is massively
Don't pick on our
disinflationary.
libertarian.
No, I mean,
I love libertarians.
Look, and you were exactly right. I think the internet had a big disinflationary impact. I mean, efficiency is wonderfully disinflationary. So, I mean, I have high hopes, but I also have a reality that we have a government that continues to spend, and the bond vigilantes, Taylor, I think, who you alluded to. I mean, these are the supposedly big, smart bond traders of the 1970s.
She might be one of them. We don't know, so just be careful. what
Keep
you
your
say.
eye on rates. If rates really start to spike, that's going to be trouble for stocks.
Well, if I had the choice, what I was trying to allude to is I'm not going to loan money to Uncle Sam, but I sure as hell will loan money to Microsoft.
I was going to say, not Google.
No, but you know,
What
a
if Google
large,
comes knocking? Maybe kick them a little bit. You know, they're bad.
Well, I own it all. If I would own it all if you own a mutual fund that invests investment grade debt.
Yeah, and I'll just say LQD, not an investment recommendation, but LQD is an ETF that invests exactly those, the high investment grade corporate debt. So one to consider, do your own due diligence, but LQD is the way to play that trade.
Okay.
You want to do
Hey,
more
what
stuff?
say you?
Oh, I mean, I don't really have anything else to add than I already did. I get nervous, and I believe in asset allocation. I don't necessarily agree with that formula. But Dagan, for these folks who are pouring so much of their savings or their net worth into the stock market, I worry about that at these levels.
And you're
The
defending
risk.
the libertarian over here.
Well,
too.
because I just
He
feel like
needs a
sometimes he gets a
defender. I
little
think
extra
that's
slack,
very
and
fair.
I
think
feel
that's
bad.
very
Defend
nice. I think that's very nice.